You don't need an army of accountants to perform hedge accounting. Welcome to CurrencyCast. My name is Agustin Mackinlay. I'm the financial writer at Cantox and your host. In this week's episode, we're going to see that the documentation required for hedge accounting can be easily automated, allowing you to save on administrative costs. Consider a US-based company that signs a contract to sell goods to a European customer in euros for settlement, say, in 6 months' time. The transaction is hedged and the company sells a corresponding amount of euros for a value date that is set to coincide with the settlement of the underlying commercial transaction. From an economic point of view, the cash flow exposure is fully protected, as changes in the exchange rate will lead to mutually offsetting foreign exchange gains and losses. From an accounting point of view, things might not be so clear-cut. While the derivative position will be recognized from day one, the sale will not be recognized as an account receivable until it is invoiced. So in this example, a large upward move in the Euro-USD exchange rate might lead to a large unrealized foreign exchange loss that will find its way into net income. And there is the paradox. While foreign exchange risk management has as one of its goals to diminish the variability of performance, in this case, we would have more and not less net income volatility. The solution to that mismatch, according to standards set by IFRS 9 and US GAAP, is hedge accounting. Hedge accounting allows companies to take those unrealized foreign exchange losses out of net income by placing them in other comprehensive income, or OCI, until the derivative position is cash settled. In order to be eligible for performing hedge accounting, companies must provide extensive documentation regarding the objectives of the hedge. Regarding the type of hedging, is it cash flow hedging, is it fair value hedge? And they must provide extensive documentation as well regarding the exposure. Is it exposure to currency risk, like in this case? Is it exposure to interest rate risk or exposure to currency price risk? And information must also be provided on the hedging instrument and the hedged item. Last but not least, companies must proactively assess the effectiveness of the hedges. That is to say, they must proactively assess changes in the fair value of the hedge instrument relative to changes in the fair value of the hedging instrument. So I think that you see where the problem lies. If manually carried out, the process of compiling the documentation that is required for hedge accounting can be massively time-consuming and expensive too. We've seen companies shying away from implementing hedge accounting because of the perceived costs, even though they know that net income volatility induced by FX movements can be taken out of the equation thanks to hedge accounting. And we've seen companies shying away from foreign exchange risk management altogether because of the perceived costs. Currency management automation solutions working alongside your existing systems allow you to easily automate the whole process of compiling the required documentation for hedge accounting. Thanks for watching. If you enjoyed this video, make sure to like, share, and subscribe to our channel in order to keep up to date with upcoming episodes.